Hey there, future financial gurus! Welcome back to the channel where we turn confusing money stuff into plain English, sprinkled with a little humor, of course. Today we're diving into the world of mutual funds. That's right, the classic investment option that's been around since disco was cool and people still read newspapers. By the end of this video, you'll know what mutual funds are, how to invest in them, and why they could be your new best financial friend. Grab your coffee, a notebook, and maybe a cookie because we're about to make mutual funds fun. Yes, that's possible. Let's jump in. Alright, picture this. You walk into a candy store and instead of buying individual candies, you grab a mixed jar with a little bit of everything. That's basically what a mutual fund is. A mutual fund pools money from multiple investors to buy a diversified mix of assets, stocks, bonds, or even real estate. Instead of trying to pick individual winners, you're letting a fund manager do the heavy lifting. So, if stocks are like cooking from scratch, mutual funds are like grabbing a meal kit. Someone else prepped it for you, you just enjoy the results. Now, mutual funds come in all shapes and sizes, like socks at a discount store. Let's break down the main types. Equity funds. These invest in stocks. High risk, high reward, like trying to bake your own sourdough bread. Bond funds. Focus on bonds for more stability. Think of these as the grandparents of investments, steady and reliable. Balanced funds, a mix of stocks and bonds. They're like trail mix, some chocolate for excitement, some nuts for nutrition. Index funds, track a specific market index. These are the lazy genius of the mutual fund world. Money market funds, low risk, low return, perfect for short-term goals, or if you're scared of the stock market roller coaster. See? Mutual funds are like an all-you-can-eat buffet. You pick what works best for you. Now, why should you even consider mutual funds? Let me give you the highlights. Diversification. A single mutual fund could give you exposure to dozens or even hundreds of investments. It's like owning a stock market sampler platter. Professional management. Fund managers do the research and make the investment decisions. So, if you're busy binge-watching Netflix, they've got your back. Liquidity. Need to cash out? Mutual funds are easy to sell. No waiting for months like with real estate. Low entry point. Many mutual funds let you start with as little as $500 or sometimes even $50. No excuses. But before you go all in on mutual funds, let's talk about the fine print. 1. Fees. Mutual funds can have expense ratios, management fees, and sometimes even sales charges. These can nibble away at your returns like termites on a wooden bench. 2. Lack of control. You're trusting the fund manager to make decisions. It's like handing someone else the TV remote. Risky. 3. Tax implications. Some funds can trigger capital gains taxes even if you didn't sell anything. Sneaky, right? Basically, mutual funds are like your in-laws. Mostly great, but they come with their quirks. Let's get practical. Here's how to invest in mutual funds, step by step. Set your goals. Are you saving for retirement, a house, or your future yacht? Your goal determines the type of fund. Pick your platform. Choose a brokerage or investment platform. Fidelity, Vanguard, or Schwab are popular choices. Research funds. Look at the fund's performance history, expense ratio, and investment focus. Pro tip, lower fees = happier wallet. Check the minimum investment. Some funds have higher entry points. Don't worry, there are plenty of affordable options. Start small and add regularly. You don't need a mountain of cash to start. Invest small amounts consistently. That's called dollar cost averaging. And boom, you're officially a mutual fund investor. Easy, right? Think of mutual funds like a pizza party. Instead of buying an entire pizza yourself, you pitch in with friends and everyone shares the slices. For example, let's say you invest $1,000 in a mutual fund. That fund invests in 100 companies. You now own a teeny tiny slice of each one. And the best part? You didn't have to research all those companies, your fund manager did it for you. Here's what not to do with mutual funds. Ignoring fees. Always check the expense ratio. Anything over 1% should make you raise an eyebrow. Overloading on funds. Diversification is good, but too many funds can overlap and cancel out the benefits. Short-term thinking. Mutual funds work best for long-term goals. Don't panic if the market dips, ride it out. And that, my friends, is Mutual Funds 101. Whether you're saving for retirement, a dream vacation, or just building wealth, mutual funds are a fantastic tool to have in your financial toolbox. Now here's your homework. Like this video to show some love. Subscribe so you never miss more easy-to-follow investing tips. And share this video with that one friend who still thinks keeping cash under their mattress is a good idea. Thanks for hanging out with me today. Remember, investing doesn't have to be complicated, just smart. I'll see you in the next video. Until then, happy investing.